Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, November 27th, 2019. Just a quick reminder, U.S. markets are closed tomorrow for the Thanksgiving holiday, and then also an abbreviated trading session on Friday, close at 1 p.m. I'll be out of town on Friday, leaving for the holidays to go visit family over on the other coast, and we'll pick up, everything next week. And as I've been saying, I don't trade much this week. I'm taking some time away from my desk, keeping things light. I'll try to get back to any questions by the end of the day or before I leave town tomorrow. Any questions in the trading room or under the posts on the front page, and then we'll again pick things up come next week. But what I wanted to do is an update on commodities. We're going to go over. I'll start with the commodity ETFs. Here's a watch list that I have. You have various ETFs, or a lot of these are actually ETNs, just a technicality. But you have wheat, corn, soybeans. We're going to go through these. Not everyone on here, and I just wanted to point out. As far as even for looking at archives on the site, when you go to the bottom, you can see the FF at the end of these, or the letter F, at least a single F, and those are the older ones. A lot of these commodity companies, or a couple of them I should say, such as Joe, which we've been highlighting lately, they changed the ticker, retired their old ETNs, and rolled out some new ones a couple years ago, and those older ones are still trading on the secondary market or over-the-counter market, but we're not going to get into those. I just want to mention that you see that down on the list. How I want to do this, I'm going to start with the agriculture commodities because there's quite a few. We'll go through those. I don't want to make it a very long video, and time permitting, I'll roll into the the hard commodities. Soft commodities include agriculture commodities, pretty much anything you grow, anything that grows, whether it's plant or cattle, livestock, for example. That's soft commodities. Things that you mine or pull out of the ground, such as oil, gold, industrial metals, those are hard commodities. So we'll kind of break it down here depending on how quickly I get through these ag commodities, and if I don't get to the oil and natural gas, and maybe timber, or lumber I should say, and timber. There's an ETFs that hold timber companies. Then I'll do those in a separate video. Sorry, I'm going to move this to the side here. We're going to start out with coffee. I want to start with coffee because this morning the Wall Street Journal, they send out emails every morning if you're a subscriber, and the headline was coffee futures are perking up. Well, yeah, it's a little bit of left side of the chart. Coffee's already up almost 25% off the recent lows on this rally recently. But I'm gonna and because of that, usually when you start seeing the headlines, highlighting something as being bullish after it's had a big run, that's about the time you get at least a correction. I'm not looking for the end of the run. So let's start out. I'm going to start out here in this weekly chart because this is the bigger picture, and these are coffee futures. You see over here the continuous contract. Stockcharts.com will use the symbol $COFFEE, and whereas when I get to the actual futures contract, or the continuous contract I should say, on my other charting program, it's KC/KC. And one other thing worth noting is that the stockcharts.com, on their futures, they give you end-of-day pricing. So whatever's happening during the day, that's, you're always going to see yesterday's closing price and how the candle looked until later after the market closes. That's when they update these charts. So what stands out to me is this downtrend line. I've highlighted this chart several times in the past. In fact, right here off this divergent low, that's when I started making a longer-term bullish case for coffee. Here, let's start there. Okay, coffee bottomed to put in what appears to be a major bottom back on May 7th earlier this year. This chart we're looking at here was one that I posted on the site back on, it's a screenshot through May 7th, but again it was an end-of-day chart, so I took the screenshot the morning before the market opened on May 8th down here. And so that's the bottom. That was the very bottom in coffee right there, and I started making a bullish case for not just a short-term trade, but more of a trend reversal. If you look at this weekly chart, you can see this is where I look for these divergent lows. And again, a divergence is not a sell signal, just like in the stock market. You need to see some buy signals. Here was a breakout finally, and that set that trend, which really that trend didn't end till right here. We had a correction along the way, but that was a pretty powerful trend there. And then you had a downtrend that followed, divergent high, all the things you look for. So you can see the chart and screenshot it, divergent low, These are the trends you want to swing trade or trend trade. In fact, you can call this trend trading, which is like swing trading, but to give it a little bit more room on your stops, not jump out at the early price targets. And so again, the case was made for a longer term position. I think the case is still there. That's why I'm spending a little more time on coffee than some others. But I'm really liking a lot of the agricultural commodities, and have for a while. And I think the risk-reward profile is more attractive. I think there's more upside potential. I have very little doubt we're probably much closer to a new bull market in commodities overall than we are. In the stock market is at the longest bull market in history. So we know we're getting eventually closer to the next bear market in the stock market. And these guys, commodities as a whole, forget about coffee, but or you can look at it. It's been with most other commodities in a bear market, a pretty vicious bear market since back here. You can see around 2011. So again, that was a low there, and this was the buy trigger. Remember, divergences, I always say, are not a buy or sell signal, just like the stock market right now, diverging, and that could have continued, or the divergences could have been burned through. So the next update was posted back here on May 24th, and that's when I put Joe, the last official trade. These are the same targets that we're using right now. Like I said, official, unofficial. It's the Joe is what I've been highlighting for those of you who like to trade ETNs, or you can trade KC, which are coffee futures. And so you can see that was again the entry criteria for that last trade. But I want to show you these charts. So just after it bottomed back in early May, on May 24th, I updated. We had a breakout on the daily chart. So this is takeaway here is I like to use multiple time frames. We had a clean bullish falling wedge, nice clean bullish divergences on this daily time frame, and we had a breakout. So there's your buy signal back then, to get in, and that coincided with the breakout in Joe that I just showed you. And here's that weekly chart I showed you. This was a couple weeks later. We still hadn't yet broken out of the weekly chart at that point, but soon after we did. And in fact, there it was. This was posted back on June 6th, showing you that weekly chart, a solid impulsive breakout. So again, that's what you like to see, an impulsive move up through there. So that was then. This is now. Let's get to the current chart and see where we might be going. Okay, here's what I start out with. So at the time I had this downtrend line, or at some point I had it. This right here was the downtrend line that I posted back when coffee was bottoming right here, this downtrend line. And then we broke out, hit this trend line I added afterwards, sometime afterwards. We had a pullback there, and that's actually, I think, when we hit that third target on the last trade, pulled back, and now what I want to point out, we're at this trend line here, this trend line off. It's the same, generates off the same high, that late 2014 high, but I came in and I've caught this reaction. Now we don't have a reaction here yet. I want to say that. I like to say that a trend line needs 3 distinct points to help validate it, because any 2 points can be connected at random. So on top, like this is just a divergence line, really more so than a trend line. And here's your uptrend line with a lot of reactions along the way, a lot of reactions there. A downtrend line, you want to see a lot of reactions. And so right now, this would be a potential downtrend line, so I just wanted to point that out. Now, if we blast on through there, I'll remove this line. It really won't, because we won't have a third reaction at that off the level there. So we'll have to see what happens probably into next week, because it's a weekly chart. And then these are the same targets I had back then. Now, they're not 60 or 90% from where we're at now. They're 60 or 90% from where we bottomed back then. So that's the longer term picture. And based on these divergences and everything that's happened since I started to highlight back here, the divergence was number one, confirmed with the bullish crossover. We've seen bullish price action so far. And so, if we can break out above that level, I believe that would open the door, especially if we get a reaction first, help validate it, and then break out. But either way, we could continue up right on through that trend line, and the chart still looks constructive, again, longer term. And that level, you can see it's right up just north of 140 level on coffee, with that next target up there about the 170 level, and then a move all the way up here to maybe that 230. And if and when we get there, there could be more. I mean, that's the previous high from back in 2011. We'll just have to assess the charts as they go. All right, so let's look at the JO. That's where a lot of people trade the ETF or ETN, and that was that last trade back there, hit the third target. At the time I said, pullback is likely based on the technicals at that point, as I did back when T2 was hit. So, that allowed some to either tighten stops or to get out, and then that trade went on eventually to come back all the way down to just a little bit above where it bottomed before. So far so good. I want to point out, as I did the other day, there's some divergences on the 60-minute chart. Joe, let's focus on the futures when we get to the 60-minute, because remember, these ETNs, all they're doing is they're tracking the futures. The futures are the pure play, and this is KC right here, coffee futures. Keep in mind they shut down trading. I think it is 2 p.m. around that time, somewhere around midday, mid-afternoon. They stop trading. So you're going to notice if you're trying to trade Joe, buy it. You can still buy it and sell it up to 4 p.m. like any other ETN or ETF, but it's not going to move much because the coffee futures have stopped trading, and the spreads are going to widen up. So keep that in mind. So we broke down. I highlighted another most recent divergent high and this wedge pattern. We broke down. We did have a little correction. We've kicked back so far. If coffee does go up higher, which it may, maybe that bullish pump from the journal today, that article they published about coffee futures perking up, that might give it a little lift. Maybe not. But I could see that, easily see that. I did talk about a correction, maybe down to one or either of these targets. These are support levels. But I want to maintain that, the longer term trend still looks bullish, and the odds for correction are elevated when you get these divergent highs. So it depends on how active a trader you are. If you're a long-term trader and you're trying to position for what may be the start of a new bull market in coffee, then you want to give it a little more room. If you're an active trader, that's the levels that you can either add to if you have a position, or if you're not in it, if we get a pullback to those levels, possibly all the way down here. As of now, it's hard for me to really say. I don't have a lot of clarity on this chart, but I can tell you this: I would not be surprised at all. Just my read on this chart, if we went up here, extended that divergence, maybe come in and back test this, put in another divergent high, and like I'm showing you here, extend the existing divergences that are in place, come in and then reverse. Either way, coffee's getting a little bit stretched. And to go back to that Joe trade, there it is. You're now getting very close to that previous third target, right around 39. Let me give you the numerical value, the actual resistance level there. It's about 39.14, and this level right here is about 41.50 or so. And again, I always check on how the futures look if this ETN, because the ETN, Joe does a pretty darn good job of tracking coffee prices, but not perfect. Like any ETN, it's trying to roll the futures contracts. There's going to be fees involved with that. Some tracking error depending on when they roll the futures, and things like that. As of now, if I look at it here, I can see an uptrend line, I see a breakdown, and a high-level backtest. So I really don't think the risk reward is very attractive at this point, because I think the upside is minimal. We'll probably get a reaction there. But if you're in the trade and you don't want to try to time the pullbacks, again, that's how you can capture a longer trend. You're just going to have to use a wider stop, maybe somewhere down here. We already had a pullback and a reaction to this level. I would say somewhere north or around that 35.70 level if you want to just let it run and ride out pullbacks. Otherwise, of course, you could use a more aggressive stop. And then finally, one more potential line that could come into play, and I'd want to see some resistance on the futures as well, because of that, the fact that Joe as an ETN isn't going to do a perfect job tracking over time. So this trend line may or may not come into play here. But I can say this: sometimes it's a case of the tail wagging a dog. I don't know how much. There are some commodities, such as gold, for example, where the inflows and outflows of the ETF are so large. Gold is such a popularly traded ETF, GLD I'm talking about, that it can affect the price of gold from inflows and outflows. When everyone's selling their GLD, it then in turn, the ETF company has to then sell their gold, and it can cause the price to go down. I don't know if, and I would doubt that you're probably seeing more money in JO than the actual coffee futures. However, what I'm getting at there is a possibility that traders, when they see this level, if they're trading off here, and a lot of people step in and sell at 39.14, or they buy a breakout of 39.14, that could affect the price of the futures. indicate a pullback here. So, all right, so let's move on. Near term, like I said, I could see the potential for a little more upside, but the risk of a pullback at this point is somewhat elevated based on those technicals. Again, going back to this 60-minute chart right here, the divergent high, I should say, and the fact that any additional marginal new high, as long as it's not too high, will still be a divergent high, because it will just simply move this line up here, this trend line right here, and pretty much, you know, anything up to that point would still be negative divergence. And so that's that. So my preference would be to hold off at this point. You know, hold your position if you're a trend trader or even a long-term swing trader. Raise your stops to protect profits in case it suddenly corrects. But then look, if we get a correction, we might look to buy and re-enter a pullback here for the next trend up. Okay, I won't spend as much time on the rest of these, and I'll focus on the ETFs right now, or ETNs. This next one up is wheat. Here's another one I've been highlighting in recent months. We've had it back here as an official trade, went up, hit all three targets, got out, and then it reversed. And then I mentioned it again down here. I honestly can't, must have been an unofficial trade, because if it's official, I'll usually do the T equals. But again, like I said, the commodities are, if nothing else, I think the key to investing and trading is asset allocation. Don't put all your eggs in one basket. Don't put them on one asset class. Have, you know, whether, depending on the timing of things, stocks, bonds, commodities. And within commodities, like I said in the beginning of the video, you have your soft commodities, hard commodities. You know, I might be at one point bearish in short energy commodities, or, you know, whether sometimes I'm long natural gas and short oil. You know, they don't have a perfect correlation between those two. So, you know, like I said, just a percentage of your portfolio makes sense in these commodities right now, and for the most part long or bullish, especially for a trend trade. You know, the short pullback trades on things like natural gas and crude oil have been more of what I call tactical trades recently, and you know, these are more strategic long trades, swing trades, trend trades on a potential bottoming play here in a lot of these commodities. So there's wheat. When you look at the ETN, it may not look exactly the same when you look at the futures, but you have a roughly double bottom on the ETN. It's a pretty clean looking chart, in fact, and you have a nice downtrend line, which I've just added to this chart recently, and we're testing that now. We're broken above it, but not by a wide margin yet. And remember, this was that was the second target back here. It's a pretty decent resistance level. This was a momentum fueled overshoot. We hit the, you know, again, the first and second target, pulled back. We've been consolidating. This is so far a healthy price action. Nothing goes straight up. Sometimes you can run a little more, but the more overbought you get, the more stretched, usually the bigger you fall. So this is healthy correction or consolidation so far, and I think that's we'll watch this one next week. I like the posture of the PPO. I like to use the PPO quite often on not every stock, but a lot of stocks and commodities or sectors. You look at that zero line right there, the dotted line, and when the 9 EMA or the signal line is below, crossed down below, and it stayed below this whole time right here, and it said you were in a bearish trend. And look above, look what prices did. Crossed above right here. Actually, you know what? That line was wrong. There was where we crossed above and then crossed back down below. So, you know, it's not a timing indicator, but what it does help to do is confirm a trend. When you're in choppy sideways consolidation, you're going to get whipped around, but you can see right here that trend, it told you throughout most of the time, and more importantly, when you had little counter trend rallies and that PPO came back, that signal line, not only do I use it when it crosses above or below to help confirm maybe a potential trend change, but once you have a trend underway, bounces back to the zero line when from below. Often the zero line will often act as resistance, as it did there. So you were rejected again. And what's happening right now, same thing in reverse. We broke above right here, and that's indicating this may be the start of a new trend with more to come. And you can see how the PPO has come back in here and starting to roll over, and so far it's above. So again, this is what I'll be watching for going forward next week and beyond. Do we hold this level? Do we hold above this trend line and then start to move up? Even if we were to come back in and consolidate a little more and then break out, then that might be an objective long entry. So that's wheat. Let's go to corn. Corn and wheat, often trade together. You can see the charts are not identical, but there are a lot of times for the most part they tend to trade together because there are two reasons. They're alternative grains for each other. You know, if you're a farmer and you have your pigs or cattle, whatever, you can feed it corn, you can feed it wheat, and you know, if prices go up on one, you know, think of your favorite Mexican restaurant. You order the fajitas, they're going to ask you, do you want the corn or the wheat tortillas? You know, it's either one. So pretty similar, and the fact that they're grown in, for the most part, the same climates, temperate climates. You know, so coffee, for example, is grown in tropical climates or subtropical, so you don't have the same weather patterns. You know, extreme drought, things like that can affect. So that's one reason you're going to see corn and wheat usually move together. Now, so what I'm seeing here is corn right now. You can see the downtrend line has not been taken out. I'm watching this downtrend line closely. You can see we had RSI divergence down here. You see I wrote this was a divergent low. Both the RSI and the PPO were making higher lows and prices making lower lows. Right here you had the RSI continue to make, right down here at the bottom, a higher low, but not the PPO. What I think would be a beautiful setup, we may or not get it, but if we do, extend this line right here, undercut this low, what that would do, or has the potential to do, keep that RSI divergence extended as long as we continue to make higher lows here on the RSI, and have this PPO come down, and that would give us a nice clean divergent low right there, at which point I might even take a starter position right there in corn, and you know, with a stop somewhat below in anticipation of a breakout, but then your buy signal would come, of course, on the breakout and once this divergence is confirmed. Now, I'll have to look. This video is going a little bit longer than I thought, so we're going to keep it on these ag commodities. I'll also want to confirm what I see on the corn futures chart, the daily and the weekly chart, and the 60-minute chart. Again, because we may already have, you know, I can do that for you right now. Let's look at the corn weekly chart here. Yeah, this is corn weekly, and see, it doesn't look exactly the same, but again, we were just looking at a daily chart of CORN, which is the ETN. This is $ CORN, or the continuous contract of corn. What stands out to me on this chart, it's really it's not given a lot of clues as to where it's going, but what I can say, it is consolidating. I've had this R1 zone here for a long time. We've had a lot of reactions off that level, not just since this in trading range started, but back here. This seems to be an important price point for corn, and it's been bouncing around in here. And again, I'm seeing a lot of ag commodities starting to firm up, so I favor, although we don't have the buy signal yet, I favor an upside break, and that's a pretty powerful basing pattern. What I mean by that, you know, when you're in this is a sideways consolidation range, it could be a basing pattern just like this was right here. You see, you traded around in a sideways range for a while, and once you broke out, you didn't just limp around and you exploded higher. And that's the nature of a lot of these commodities. You know, the market gets caught off guard with some imbalances, and then everybody all of a sudden wants to buy corn futures. And sometimes there are crop conditions that, you know, cause that, you know, shortage. It could be tariff slapped on or something to do with that. But again, we can guess all day long about that stuff. You're not going to predict the weather. The charts, let the charts be your guide, and you'll be surprised how often they can predict future price action. So this was a false breakout right here, given, you know, that you had I don't even know if you had a weekly close. All those candles look to be right about it, closing around the top of the zone. Either way, we'll be looking for a breakout above. Could it go down if it breaks below the channel? Yeah, probably, but I don't think I want to. Commodities are really beat down. I don't care to short them, and you know, you're only going to go down to a certain level. Corn isn't going to file for Chapter 11 bankruptcy protection. Corn isn't going to have a CEO involved in some scandal or an accounting scandal like a corporation. So that's why you have there's a floor, if you will, in commodities. There's always going to be that value and need for it. Unlike corporations, with the best of the best corporations here today could be gone tomorrow, depending on what happens. Think WorldCom, Global Crossing, all these big companies in the past that So either way, let's not talk on it anymore, because that near-term chart, or the long-term chart, I said, isn't painting a clear picture other than if we break out above. But I do like this daily chart right here, and so we'll be watching corn there. Soybeans, testing my patience. I've talked about this in the past year. I've been trading now, professionally for many years, over a decade, and then even before that, at part-time as before I embarked on a full-time career as trader, and I have never ever seen so many stop raids. I don't know if this is such a thinly traded thing, and everybody, there's enough people on the site that put these stop orders and the market makers see them, but this is a common theme. I'm looking at, I could go back, and at one point I'd like to do that, put together all the trades that have been stopped out this year by a penny or two. It looked to be a well-placed stop at the time, and that stop was hit today at a low of 14.97. I had a stop of 14.98, and look, I'm not crazy about the way the chart looks now. It may go down more. As that was a stop, this trade will be, as soon as I update all these trades, that'll be removed. I may add it back, but I wanted to go over that. The fact that that stop was hit today. I'm not crazy about what I see here on the daily chart anymore. I really thought soybean had a chance to rally when we entered that trade recently. So, and if you want to give it room, I also said this several times this week. Personally, do I try to avoid taking new positions the week of Thanksgiving. Those that I have, I will usually either pull my stops or widen them up because of the low volatility in the markets, not just the stock market, pretty much everything, commodities. People are on vacation, whether it's Thanksgiving Day or before that. And with that low volume comes extra volatility, and it's a field day for the market makers, for the algos to run stop rates. Let's say you were, had nefarious intent. You ran an algo, you had $billions, multiple billions in a hedge fund, and your program was run to sniff out stops on where the retail traders have stops. You can buy that information, number one, from the brokers, probably from the exchanges. You can certainly see any orders standing out on a market, stop orders that are sent to a market, and you can also, algos can look and say, where would a logical stop be placed, a cluster stop. So we go in and we hit those stops, everybody sells out, then we turn around on the stop, we buy those shares, and we play the bounce. That's what a stop rate is. And I don't care how big your fund is, you're probably not going to move Apple stock enough, especially on a busy trading week or busy trading day. You probably don't have the buying power to pull Apple down 3, 4, 5% to run stops because it's such a liquid and actively traded company. But things like this you can. So that's it. Like I said, right now, up to you if you want to hold it, let it go. Let's take a look at the chart of the futures real quick. Okay, here's the weekly chart of soybeans, and here's what stands out to me. And this is why I'm looking to, this one technically, like I said, stopped out because I didn't pull or modify the stops this week. But if I like what I see, I'll add it back next week. But here's what stands out. This goes back well into 2004 right here, and you can see what this says right here. And I've shared this chart in the past. Major bottoms in soybeans came just shortly after the initial oversold reading when the RSI made a slightly higher low. In other words, positive divergence. So you can see that's what these arrows show. There's your divergent low right there. Divergent low, divergent low. There's your divergent low. That was the first one. There's your divergent low, and they're up here. You can see bullish divergence. Just like back here, you had a divergent high, a divergent high. That's it. I don't think I missed any, and you can clearly see those are the major trends. Let me change this. Cool. So you had, after that divergent low, you had this rally, and that's a big rally. You're talking from about $500 to about $1,800. That's more than back then about 1,500, 16, more than a triple right there on that trend. In fact, and then you had a divergent high that said get out, and again weekly chart. So these are your trend trades. Big correction. From there we rallied. From there, and then we broke this trend line back test. So you can see everything on the chart, but again, let's forward on what's happening now, or what's happened more recently. We just put in the first divergent low since back here in 2016, and that 2016 rally, that was about 800 and a little over $800 up to about 1,200, so 50% give or take rally off that divergent low. Now the bigger picture is commodities, as I said, including soybeans. Most commodities, pretty much all commodities, have been in a bear market now since about 2011, 2012. So the primary trend's been bearish, yet you've had these bull market rallies. So this, so far, we had a divergent low that, as you can see, has not played out for anything near these other bear market rallies. But what I'm looking at is sooner or later the bear market in commodities will be over. It may have already ended, only time will tell. And so what I'm looking at is that we have a nice clean downtrend line right here. And so you had the divergent low. We ran up, hit the trend line. I would imagine sooner or later we break out. And if we do, that's a pretty powerful buy signal. Very powerful. Why? That's your bear market trend line. There was the high. That was the end of the last bull market. This has been a bear market. That's your downtrend line since that high right there. So a breakout there could be the catalyst for a new bull market. And so again, stop out of this one. If the charts look constructive, I'll just sit back, look for the next objective entry. And again, if you want to give it room, that's up to you. But based on this divergent low back here, would indicate most likely there's more upside to come. There are no guarantees, but those are the things I'm looking at. Okay, so I spent the first part of this video so far covering, and I'll whip through the rest, wheat, corn, and soybeans. You want to kill 3 birds in 1 stone, you can go with JJG. That's a grain ETN, and it holds wheat, corn, and soybeans. So there's JJG. Needs to break out of this downtrend line. We had 2 bullish falling wedge breakouts, as you can see here, recently. And let me change color on this here. And there, you had a big rally after that breakout. There was your move up. That set up, and we actually had divergence right there, negative divergence on the RSI, led to a correction, then another bullish falling wedge breakout, which so far we have a correction, but a break of this trend line should bring us back up to that 46 level again, and I would expect probably a breakout beyond there. So again, if you want to you don't have enough to diversify among various commodities, you could use this one. You're at least buying 3, I believe it's those 3 grains if I'm not mistaken, and you could just do a Google search and go to the company's website. They'll tell you what the holdings are and what percentage. And then even more diversified is DBA. I've mentioned this one in the past. I've modified this trend line a little bit. That's the Invesco Deutsche Bank Agricultural ETF, and here's your holdings. I haven't updated these recently, but it gives you an idea. As of March 15th, live cattle 14%, soybean, sugar, corn, cocoa, wheat, coffee, lean hogs, feeder cattle, and cotton. So kind of a shotgun approach. You're pretty much covering all the ag ETFs there, right there, or all the ag commodities right there. And again, it's so far bottomed in September, and it's been a nice lift. About 11% gain, nothing huge, but a decent lift so far. My concern a little bit that there's some divergence there. Yeah, that divergence could play out. And again, I modified this trend line a little, so this is a reaction so far. So maybe we pull back, maybe not. Either way, whether we pull back now and break out later or break out now, that should bring us up here to these target range. There's about 3 targets. And again, I'm looking at this as maybe a bottoming play for maybe the next bull market in commodities. And you want to go even more diversified, instead of just agriculture commodities, or instead of just grains like I showed you. This is really probably a one-size-fits-all. This is the Wisdom Tree Continuous Commodity Index Fund. It tracks I forget it's a different company, the Continuous Commodity Index, and you have roughly equal weights in all these commodities right here. You can see it up here: cocoa, coffee, copper, coin, soybeans, cotton, crude oil, gold, heating oil, lean hogs, live cattle, natural gas, platinum, silver, soy oil, sugar, and wheat. So there it is. You've got so the difference here, you have your ag commodities, both soft and hard commodities. You can see this is from their website, although the Wisdom Tree website, but that doesn't make sense because they're telling me they're 23% in softs, but then you have almost that much in grains. And either way, you can, like I said, I pulled their site up, and they are almost equal weights in each of these. So that's not a bad way to go, and it looks pretty good. You can see it's taken out this downtrend line. Nice divergent low. We had bullish divergence building on the PPO since back here, and we had divergence on the RSI since this point. So there's your second divergence line, bullish divergence, and it's moving up. Targets, I can give you targets, but again, it's more of I don't see a hard buy signal right now. It's just kind of, I'm highlighting this as maybe a portion. If you're looking for some diversification in your portfolio, asset allocation, then this is an area, one that you can certainly put away, and you want to stop. I'll probably, if I add this as an official trade idea, of course I'll give levels, but at this point, maybe a back test at the worst case scenario, and come in here. I'd really not want to see it go much below 1740. So maybe if you pull back to that level back test, it's also price support. That would be an objective long entry with a stop somewhat below there. And if we continue higher, look for resistance here about 1845, and we'll go from there. And this is sugar, SGG, and what stands out here, you see this is your divergence line. So you had positive divergence here at this recent low back in September, also on the RSI down here, and you broke out of this downtrend line, went up, hit the secondary downtrend line, pulled back, been moving up. So I probably should add a price resistance level. So that's it. They've been catching a bid since September. That's the common theme here. You cannot say that these things are out of their bear market. There's just not enough evidence in the chart to say that the bear market is over, but we can say near term most of these commodities are in a bullish uptrend this year, and the charts also look constructive, so it may prove to be more than just a bear market rally. So this one needs to take out the recent highs about 40, 45 or so, and then this trend line may come into play right here. In fact, I would probably expect it would, but that's right around the same level, so that's what you want to look for in sugar. I'll have to dig a little deeper. I haven't done a deep dive into all the charts here, but I want to look at the futures and take a look how that and just see where the objective buy points are. So again, I'll follow up on a lot of these commodities, especially those that stand out to me lately. Obviously, coffee was the one that stood out the most, hence the most updates there. And second to that, really wheat and corn I've been highlighting in the last few months. And cane is another sugar ETF, just a different company there, and you can see that one broke out, and there it is, downtrend line breakout. Not really moving up impulsively, but you have the early makings of an uptrend so far, with sugar making a series of at least not yet a higher high. If it breaks out above these recent highs right here, let me put a line, then that'll give us a higher high, and it'll help reaffirm that we're in a near-term uptrend. So far, we're making higher lows right there. So that's where cane needs to break out. I'll probably have to, yeah, I did. I just changed that line to reflect more accurately target up here around 723 or so. NIB is cocoa, ETN. Forgive all these lines. I've had these are trades that we've had in the past on this one. I just haven't cleaned this chart up lately. Long trades and short trades. There's short right here, a couple targets, longs back here. Those targets were hit, and it's been in a pretty big choppy range, but if you look at it, take everything away, it is again in an uptrend. So that's why the case can be made that at the very least this one's been an uptrend since back here. Actually, you can see an uptrend is simply defined when a security is making a series of higher lows and higher highs, although right there, no, you had that big move up. So really from this point, there's your series of higher highs right there. So really we'll call this the uptrend right now. And so the chart doesn't scream at me with any breakouts or objective buy points. There is some divergence here, almost divergence. These were slightly higher highs on the PPO and RSI, but for all intents and purposes about flatline divergence there. So this one's getting a little bit stretched. It could have to pull back, and if it does, and that's something I'll be watching. I'm going to add one more line. I know it's a busy chart, but there's a big old gap right about here. So maybe a pull back to 29, all the way down here. I'm going to move that line down to 27.55. That's pretty decent support. That might offer an objective long entry there. And if we do pull back, I'll be on the lookout to see if we start to form an uptrend line. And then once again, what I see here, I may see something different on the chart of cocoa futures, and then I may modify these trend lines or not put as much of weighting in these. This one's only a potential trend line, so I think that would be an ideal entry if we do get a pullback to that level and the charts confirm. What does that mean? I look at the futures, I look at the 60-minute chart NIB, and they're also falling to support, and there's maybe some bullish divergence or a bullish chart pattern forming, something like that. And again, looking at this for maybe a trend or longer term trade here, and start buying the pullbacks. Yeah, this is COW, C-O-W, the Bloomberg Livestock ETN. And it's been moving up as well, and you usually don't see this. Normally, if the grains are moving up, if they're in a bull trend, well, I did show you actually, what was it, corn that was moving down, wheat's rallied somewhat, but you'll usually see these trade inverse, because if grain prices, especially if grain prices soar, if they're moving up very strong, it's been a rally for a while, that's going to put pressure on livestock, because that's farmers are they have to feed their cows and pigs, so keep that in mind. But as from a technical perspective, again, I'm seeing a pretty consistent rally in a lot of ag ETNs, especially since September here. And this one took out a downtrend line right here, broke out, but it was a small divergent high, and that happened, but it's back testing the trend line. So again, I'll study the charts of the futures. I will follow up with these next week. I wanted to kind of paint a broad brush overview of the commodity sector right now in this video, and then I'll try to hone it down, see if we could add a few more trade ideas, maybe add back soybeans if and when the time is right, and some other ones here as well. So there's COW. BAL is the this is a cotton ETF, BAL, and you can see we had a trend line here that was broken recently, so that's caused a correction, but this is a pretty good level. I've had this level on my chart for a while, about 39.26. You know, it was support, broke down, we back tested from below, and then were rejected. We took it, tried to take it out, but couldn't hold it. But I do think if we get another break here, could run. I like the fact that PPO is turning back up at that zero line. Again, this is said bearish trend, be out. Bullish trend so far, PPO turning up, so this could be the start of a new uptrend. You know, we've had a couple false starts, I'm going to say that. Back here, I was bullish on the commodity, and I must have added an active trade, which looked like we hit our first target right there, but fell shy of the second target. So it's been, I don't want to call it a complete failure to launch. These breakouts have panned out a little bit, but really not for much more. They were bear market rallies. Let's just call a spade call a spade a spade. That's what those were. But again, one of these, based on the longer term charts and the fact that they've been in a bear market for years, starting to see inflation tick up a little bit, and that'll help too. I think commodities, it's been more, it's a story there. It's a deflationary trade. I think that's a big part of it. But there's one to watch as well. And I think that's it. Let me just check. I'll cover these two ETFs. Wood and cut. These are not lumber. They don't track lumber futures like you might think. There are lumber futures, random length lumber, LB, depending on what chart platform you're using. But these track wood and cut, which are very similar, just two different companies. They track the timber and forestry index. So you have company like International Paper, for example. Companies that own and harvest timber and lumber and things like that. So so far so good. They've been moving up. They're tied largely to the housing market, as you guys could probably imagine. A lot of homes, or a lot of wood used building homes. Kind of basing here in this pattern. Where they go, I think, will depend on where the economy goes. If we continue to rally into the end of the year and beyond, then these guys could very well break out. If you see the housing market continue to hold up, then look for the next targets here. However, I suspect that at some point in the near future, we're gonna come down. Stock market will come down, and then we'll probably come on down here as well. And right now, let's just say I don't have a very strong opinion. They've kind of cracked above that 28.45 level here on cut, but it hasn't gone anywhere since that breakout. So that breakout may fail. I don't see a lot in the indicators. I wouldn't short it here. I just don't care to be long wood or cut. I'd rather, like I said, I think you picked up from my tone and what I've said in the last 2 days. I'm kind of sitting back. Let's see what happens after this week. Let's see next week. When everyone comes back in, the traders come back into the market, I might have a little more conviction and confidence on taking some new trade ideas. But these two, I'm watching them right now. I don't see a trade there. I'm not convinced that they're going to break out. And in fact, this one hasn't really. The recent highs were right about here in wood, and so you can see wood hasn't broken out yet. And what I would do if I was considering going long or short this sector is I would dig down to the individual components, the individual companies within here, and see if the majority of those charts are bullish or bearish. But we broke out of a downtrend line there, breakout back to us, and then we did have that leg up. So there could be more upside here. Just not convinced of it yet. We'll wrap it up here. Long video, but hopefully you guys found this useful, and I will follow up separately with the energy commodities, oil and natural gas. This has been Randy Finney with Right Side of the Chart. Hope